Thanks for joining us for the Mahindra CIE Automotive Q4 CY17 earnings call. From the management side, we are represented by Mr. Hemant Luthra, the Chairman, Mr. Ander Alvarez, the CEO, Mr. K. Jayaprakash, the CFO, and Mr. Vikas Sinha, Senior Vice President Strategy. I would now like to hand the call over to the management for the initial remarks. Over to you, sir.
Welcome, everybody. Thank you for joining us. This is Hemant Luthra, and I normally use this introductory time to say something, but I think given the results that we've got for the year and for the quarter, there's no point trying to gild the lily. The effort of the team and the result that they produce speaks for itself. So rather than take up more airtime, I'm going to hand it over to Vikas, who will analyze what we've already put on the website to you. And then when we'll get into question and answer mode, feel free to direct the questions. If you have somebody specific in mind, whether you want Ander to respond, please do so. If you want Vikas as the head of strategy to respond, he's there, or JP as CFO. And they'll take the tough questions, I'll take the easy ones, and we'll get started.
Okay, thanks, Hemant. Good afternoon. Good afternoon to all. I also welcome Mr. Ander Alvarez, our CEO, who is present on the call. I'll make a few comments on the investor presentation about MCI performance in the fourth quarter and full year CY17 before we open the call to questions. We start the presentation with slide 3, which presents the simplified legal structure of Mahindra CIE. This is one of the key highlights for this calendar year, and these highlights are presented on page 4. In this year, we have simplified the legal structure by merging Mahindra Gears into MCIE and eliminating all Mauritius subsidiaries. Our Mexican plant, spearheaded by Billforge, is now operational. Billforge India has also inaugurated an automated machining plant meant for global supplies to Ford F-150 trucks. On the customer front, we have acquired new customers in Gears and Stampings divisions in India. We have also started supplies in small numbers to electric vehicles from our Stampings and Composites divisions in India. It is to be noted that the results of Q4 C17 is also the first full quarter of direct comparison of quarterly results post the merger of Billforge. We will start with India results on pages 5 and 6. MCI India had an excellent performance in 4Q C17 in both revenue and profitability. EBITDA increased by 25% when compared with the same period last year, leading to a 0.6 increase in EBITDA margins. Year-on-year quarterly growth was 18%. If we remove the positive impact of Billforge, the rest of divisions in India grew 16% versus 4Q 2016. The sequential comparison of MCI India versus the previous quarter Q3 C17 shows a slight decline, but that is largely due to provision for VRS and forgings and other one-offs. Without these one-offs, the MCI India EBITDA margin would have been 15% in Q4 C17. The full year C17 result also tells a similar story of increase of growth and improvement in profitability. The full year EBITDA margins have grown from 11.5 to 13.3%. The growth of MCI India minus Billforge is a healthy 16%, while the EBITDA margins have remained similar. The main drivers of our growth in India have been the positive market evolution across segments, as well as the growth of our key customers. It should be noted that MCI India has grown higher than its key customers, namely M&M, Maruti and Tata Motors, both in 4Q17 and over the full year C17. A word about Billforge. While we do not show its results separately, its performance has been in line with expectations that had been set out at the time of acquisition. On a full year basis, it has achieved an EBITDA margin of approximately 20% and revenues of close to rupees 7,000 million. Our European results are shown in pages 7 and 8. On a quarterly basis, MCI Europe has grown by 24% in 4Q, where we have had a 5% positive exchange impact. But this includes the full year impact of increase in prices at Germany to the tune of rupees 68 million, and this increase is not just for one quarter. The equivalent full year growth figures are 11%, and that too there is a negative exchange rate or impact of 1%, reducing it to 10. The growth is driven by growth at CIE Forgings and Metal Castello. Profitability has improved on a year-on-year basis, both in 4Q and full year results, and the EBITDA margins for MCI Europe in C17 is 13.6%. Quality and delivery issues at our German operations have been resolved. And now, if we go to slides 9 and 10, we will see the consolidated results for Q4 C17 and full year 2017, which are a combination of the positive evolution in both India and Europe. The consolidated sales are at rupees 62,456 million at an EBITDA margin of 13.5%, which represents a growth of 22% in sales and an improvement in margins by 2.4%. In the slide 11, you will see our balance sheet. Our net working capital situation is improved in line with what we had mentioned over previous calls. Our overall net debt situation is slightly better to what it was at the end of last year and now stands at rupees 9,029 million. Please note that we have on page 12 mentioned the capex of rupees 3054 million on a consolidated basis, and a significant amount of this is growth capex, whose breakup is given in the notes on page 12. At this point, we would also like a minute to talk about the key financial parameters which we monitor and which are mentioned on page 13. We can see EBIT at 9%, which is close to the target of 10%. RONA is also better compared to last year at about 12%. All the other parameters are in line with our expectations. On slide 14, we have charted the evolution of the revenue and EBITDA percentage since we switched to the sales without excise format of reporting. The sustained and continuous improvement is a reflection of the strategy adopted by Mahindra CIE. This strategy is explained in slide 16. For Europe, the focus will be on existing projects of the new crankshaft machining line at Lithuania and ramp up of the Caterpillar order at Metal Castello in Italy. In India, the integration with the parent CIE is getting tighter, with synergy projects being identified for process improvement and technology transfer. And some of these projects have been described in slides 17, 18, and 19, which was something that you have asked for in the past. These elucidate the specific objectives, the CIE partnering process, and benefits envisaged and accrued so far. If anyone wants any details on these case studies, they are very welcome to circle back to us. And now with this, I will hand over the call back to Hemant for his final comments before the Q&A.
No, as I said, that I'm on behalf of the team, we are very pleased with what has happened. It does not happen too often that you have a quarter-on-quarter increase of 22%. You have a quarter-on-quarter increase of 96% on EBITDA on a consolidated basis, or a year-on-year increase of 48% on a consolidated basis for Mahindra CIE. So, gentlemen, it's all over to you, and if you let me handle it, I'll direct the questions. Otherwise, you're more than welcome to direct the questions directly to the CEO or to the CFO or to Vikas. All back to the moderator.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We will take the first question from the line of Ronak Sarda from Axis Capital. Please go ahead.
Hi team, congrats on great set of numbers. 2 questions. First on Bilforge. So if I can just highlight how the Mexico plant ramp up is going through, and the new Ford F-150, that would be exports from India, right?
Yes, that's right.
Okay, and so what's the revenue potential for this order? That's the first question.
Ander, you want to take that since you were in Mexico recently?
Okay, I didn't catch the question. Please, can you repeat it?
Ander, the question was, how is Mexico doing, and the F-150 orders that are coming, are they exported from here or where? Okay, so that's...
Okay, yes. I was last week in Mexico. I mean, the company is now in the ramp-up process of our customer product. I mean, the main product that we launched in Mexico. We started the production, I think, in approximately March, April last year. Right now we are at, let's say, the 50% of the output, more or less, and we continue growing. Okay, so the company is performing better and better. We have, that this learning curve being done, and we are supporting them also with the CIE team in Mexico. Okay, so and we expect that this company will be at full rate by the end of this year. Okay, so now we are following our customer demand. On top of that, we got a new project for another customer, and we decided that we had to let's say build an addition on to create a bigger building for this new project, and we add a new press that is now being ready, and we will pick up during March the components. Okay, so what we are now in, let's say, really happy with the performance of this plant, and we will be growing, and we will continue growing in the next years. Okay, so we expect to have, in this moment, the sales are very low as we are ramping up, but we will double the output in the next month, and after the new project is starting, we will be growing even more. So we expect to have a very good, let's say, growth and very positive impact in Mahindra CIE, thanks to the build for the Mexico plant.
Sure. And just if you can quantify how large would be this F-150 export order?
Should not give, no. I think this is competitive information. I think we would not have highlighted it if it was not substantial. Okay, but I'm a little uncomfortable without getting the approval of specific customers whether we can speak about volume of export orders, because that might then reflect on how many F-150 they are selling and so on. So forgive me for not.
This is largely for the U.S. market.
I would imagine so.
Yes, it's for the U.S. market, yes.
Okay. And second question was on Europe now. I mean, how do you see FCY17?
You'll have to speak a little bit louder.
Yeah, so the second question is on the Europe business, both MFE and the CIE Europe business. How do you look FCY17 in terms of revenue growth? And I mean, we have kind of achieved the best margin for that business. So I mean, are we still looking to improve it, or this would be the sustainable performance going ahead?
Okay. We're always in the improvement mode, but since Ander has been responsible for supervising what has been happening in Europe, I have asked Ander to talk about what has been done at the plant, and maybe Vikas can tell you about what's happening in the market, and therefore you'll get a more complete view. Vikas, you want to go first?
Wait, Ronak, what was your first question? You said what is happening on CY17 revenues?
Sorry, I meant CY18. How do you look CY18 in terms of top?
No, so of course the market growth is whatever it is, and we have presented all market growth data in annexure in one of our annexures, so that detail is there. But the growth in Europe is essentially coming from these two projects that I have highlighted: the Caterpillar project at Metal Castello and the crankshaft project in CIE Lithuania. So.
And regarding just my answer regarding the MFE or German business, that as you know, that was our main concern in 2016, where we had this not properly done closure of Jaco plant that create a lot of stress and difficulties also in the deliveries and the quality with the customers, and let's say that the situation was tough. In 2017, we have sold and we have consolidated all the management, and we have started supplying with normality. I mean, even you saw that we had a important growth, more than 10% of growth in this business, and we are finally also in positive EBT numbers. Okay, so it's true that we did a great job in 2017, and we expect to continue improving, of course. This is something that we are still below the CIE standards in Germany, and we need to continue working. Yes, it's tough because it's not an easy environment, but the strategy is to continue improving the business. And as Vikas explained, we have also growth strategy, especially in Metal Castello with all these Caterpillar businesses that are now ramping up, and also with the new crankshaft line that we installed in Lithuania plant, and this will give us additional growth to the business. So my view is that we will continue growing. I mean, in 2017, when the market grew something like 2%, our growth in Europe was more than 10%. I mean, we grew at about 11%. That means that we were far above the market. And in 2018, we expect to continue growing. Okay, and let's say the demand in the market in these last months it continues, let's say, very, very high.
Okay. So what I wanted to understand was, I mean, given these new orders, assuming industry remains where it is, can we achieve this 10% growth again? I mean, how large are these orders, if you can just, highlight?
Ronak, I don't know whether we will maintain a momentum, but don't ask me for a number for 10%. It could be more, it could be less, but don't ask me to forecast a number. The fact that Europe has grown, in triple digits in Q4, okay, should give you some idea that we'll do all right going forward.
Sure. Thank you. And all the best.
Yeah.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal Securities. Please go ahead.
Hi team, congrats on good numbers.
Presentation only, no?
Hello?
Yeah, go ahead.
First of all, I have a couple of clarifications. One is, would you be separately sharing the annexure which you share on excise operating other income?
JP, the question is on excise and other operating income.
See, on excise, I think you'll get all the details in the SEBI report.
Right.
So you have both, including bill forge, you'll find in the console. So that's what you will get. And on operating income, you want to know the breakup, is it?
Yeah, operating other income and other income for India and European business.
I'll share with you a little later. Right
Sure.
now, I don't have it.
Secondly, the standalone numbers which you have reported,
Yeah.
The fourth quarter includes 6-month performance of Mahindra Gears, or
Yes.
it's
6 months of Mahindra Gears.
Mahindra Gear. Okay. And thirdly, with respect to this RM-related price increase in Europe, that is for the full year accounted
Yes.
only in fourth
Yes.
quarter.
Yes.
And accounting is that comes in revenue line item.
Yes.
Okay, great. Coming to other questions, so primarily in India business, if I see there has been a sharp reduction in RM costs, primarily standalone numbers, sharp reduction in RM cost and sharp increase in other expenses. Is there anything to do with mix of outsourcing as such, or there's some other issues?
No, on other expenses, like Vikas explained, we have one-off expense. We are trying to sort of there was a recent regulation, and we are trying to use that to sort of get some permissions for the old plants we have. So it's a one-off provision of about 110 million rupees.
Other than the VRS?
VRS is anyway shown as an exceptional item separately.
Yeah.
Right. So this 110 million pertains to provisioning for...
some approvals, building approvals we wanted to take.
Okay.
You know, we've had these plants in the Gram Panchayats, and now we need to take an approval from the town planning.
Okay. Right. And so the RM cost reduction which we have seen as a percentage of sales on QOQ basis, is that to do with any mix change, or how should we read that?
The RM cost percentage.
Standalone.
Yeah, no. Yeah. I would think it is mix largely.
Largely mix, nothing to do with any efficiency related savings.
No, efficiency keeps going up every quarter, but otherwise it is the mix.
Mix related. Okay. lastly, with respect to India business, how would be share of M&M and Tata Motors in India revenues now versus say CY16?
Because?
No, it is roughly the same that we were talking about. It is roughly in the range of between 35 to 40%.
Combined,
M&M and Tata Motors.
35 to 40% of India, not of CIE.
Of India revenues. MCI India revenues, including Bilforge.
Okay. So the stronger growth in India business vis-a-vis our key customers is led by what? I would have presumed that it is because of new customers, but if share is similar, then is it increase in content with existing customers or what?
No. It is basically the growth at our customers has happened. Plus, we have had some. We have talked in the past about some new customers that are coming in. JP in the previous call had mentioned about in our stampings business we were talking to Ashok Leyland. We are talking for some export business in forgings. So those businesses have also
and gears, no?
And gears has also a new business which we have anyway highlighted. So in our key highlight section. So there has been growth in our existing customers and also growth from other than that.
Understood. And
so gears was TBK India.
Right. And coming to MFE, how should we read MFE's growth in this quarter particularly? Because if we see on YY basis, we have seen a significant outperformance to the industry. But on QQ basis, industry growth has been very strong, but MFE's growth has been relatively weaker.
MFE or MCI Europe are you talking about?
Sorry, MCI Europe.
So MCI Europe, of course, in Q4, we have that extra 68 million. So not all of it is because of that quarter. Only 1/4 of that 68 million is because of the Q4 price increase. So there is a little bit of bump up that is coming because of that. Other than that, it is because of not the market growth per se, but it is because of this ramp up in Caterpillar business and the Lithuania crankshaft business.
Okay, because on QQ basis, then we have underperformed. Is there anything to read into that, or it's more to do with the ramp up or any seasonality?
No, I don't think we have underperformed. I think we are in the same range per se. Few things here and there. When you say Q4, if you look at the Q4 commercial vehicles degrew by -5.4%. If you look at page 33 of our presentation, so commercial vehicles degrew by -5.4% on a year-on-year basis, and Q3 had degrown by -18.5%. So to that extent, you are seeing between Q3 and Q4 a better performance on the market side, but nevertheless both are negative numbers on commercial vehicles. On again the same story repeats on passenger vehicles. On Q3 numbers, if you look at that, the Q3 results were pretty bad from a market point of view. -0.4% market growth in Q3, which is now 6% in Q4. So there is some adjustment going on between the two quarters, inventory correction and so on. So I don't think we are very far off from the market figures in Q3.
Yeah, so I was referring to page 7, and their numbers are slightly different. October, December 17 versus July, September, it's passenger vehicle is 16.5% growth and commercial vehicle is 20% growth. So maybe you're referring to different numbers in that case.
No. I'm referring to the same numbers. I have said very clearly that the Q4 on a year-on-year basis is 6% for passenger cars and it is -5.4% for commercial vehicles. So those numbers are the same. What you are showing as 16 and 19 is basically between Q3 and Q4. And the explanation that I am giving is that Q3 numbers were very low. The growth in Q3 was very low. It was negative in both the cases and it was very low negative, and therefore you are seeing a lot of growth on a sequential basis. That's all I'm saying. So there are no discrepancies in the numbers.
Okay. Understood. And lastly, in terms of the QOQ margin improvement in MCI Europe, this is primarily driven by what?
No, so you are saying July to September was 12.3 and October to December was 15.5.
Yeah, the 20 basis points.
So what can that be attributed to?
Right.
Raw material.
So there's some part of it is because of the extra raw material increase that roughly 51 million rupees is extra. That is straight away sitting there. So that you have to take into account. Right?
Yeah, so that's about 80 basis point, yeah.
Yeah, so other than that, it is all improvements.
Okay, and this is largely sustainable.
Yes.
Great. Great, thanks. I'll come back in queue.
Yeah, thank you. Thanks, Dinesh.
Thank you. The next question is from the line of Chetan Vora from Value Quest. Please go ahead.
Yeah, hi, because you said that 5.1 crores is on account of the raw mat thing, but wanted to understand the balance difference because that's quite a large enough in the European operation. The margin has gone up from 12.3% to 15.5% this quarter. So would like to understand what were the verticals which has contributed to this margin improvement.
So the European thing. So that I will direct it to Ander. Ander, so basically the question is why has the margin jumped up in Europe from 12.3 to 15.5? Even if you take away the raw material increase, that would that would still be an increase from 12.3 to roughly 14.5%. So what accounts for the 2% increase sequentially in margins in Europe?
Okay. So mainly the raw material impact is clearly explained. I mean, we were negotiating with the customers during all the year, and finally we got approximately in October we were paid in advance with the, let's say, all the amounts covering from 1st of January to end of October. So that the amount of 68 million rupees, that was one of the impacts. The other impact that we had that was one-off was that during the year we were making some provisions for stocks, especially for the obsolete stocks that we had in the balance sheet. But finally, let's say, with all this stock that we had in the balance, and when we made the inventory, we had additional or provisions in excess. Okay, so we had to adjust this amount in the P&L. So that was specifically the impact, additional profit that we had in the fourth quarter in Germany. Right now, let's say overall the business is performing well, and we will continue in this trend. That's our expectation, and even we expect to continue improving. But that's technical accountancy issue that we were working or conservatively during the year, and we finally, let's say, didn't have to make these provisions.
So you mean to say the provisions which you were taking earlier in the last 3 quarters or earlier thereof also, and in this quarter there was a write back of those provisions, is it right?
Yes, that's right.
That's right. So therefore, if you look at the full year results, that will give you a better picture. Because the full year results, there is no impact of either of these one-offs.
Correct.
So if you take the full year picture, so MCIE full year results is 13.6%. So that is a very good representation of our performance.
Right. And on the European operation, the difference between EBITDA and the EBIT, which is ideally a depreciation and other costs, has increased from 36 crores to 47 crores on a QOQ level. Why there would be a jump of 10 crores on a QOQ level?
JP?
And you're looking at October 16 versus December 16 versus December 17, right, Chetan?
No, I'm looking at December 17 versus September 17, sir.
September, as last time explained, no, September the depreciation would be low because of low number of working days, because of holidays. August closure.
Okay.
Europe. They provided on the basis of number of working days.
But still in the June quarter also it was like 36 crores, sir. Even if I exclude the September quarter, if I refer to June 17 quarter, it was 36 crores, which has gone up to 47 crores. Just wanted to understand the reason. Because 47 crores is one of the highest number in as many quarters, if I look at it. So just would like to understand, even if the September is say lower because of the lower working days.
Okay. Let me come back to you, Chetan.
Okay, fine. And sir, again on the standalone thing,
Yeah.
The Indian operation I am asking, not standalone but the Indian operation, the difference between the EBIT and PBT, okay, which ideally is interest expenses, that the EBIT was like 58.6 crores and PBT was 47 crores. So there is a dip of 11 crores, which is quite a high number. Would like to understand the reason for that, for this quarter.
You are referring to
Indian operations, sir.
Yeah.
The numbers what you have reported.
Yes.
The EBIT is 58.6 crores. And the PBT is 47 crores, right?
No, you are looking at the quarter number or full year?
No, I am not looking. I am just looking at the December 17 number, sir. Not comparing vis-a-vis any quarters. I am just asking. Yeah, for the quarter, December quarter, yeah. For the December 17 quarter.
6 there.
Yeah, for the December, the EBIT is 58.6 crores.
No, 406 million is what we are reporting here. You're looking at the SEBI results or?
No, sir, I am looking at your presentation, which is on the...
Page, which page?
Slide, sir, just a sec. Slide 5.
Slide 5, yeah.
So, if you see, the EBIT is 52.2 crores, okay?
Yeah, yes, that is EBIT.
Yes.
Okay, and the EBIT is 40.6 crores, okay?
Yes, that's right.
So, just wanted to understand why there would be a dip of close to 12 crores.
See, you have gears merged in this quarter.
Okay.
And gears have significant debt of about 40 crores. And you will have 6 months interest hitting that line.
So, for this quarter, December, the gears number are like for 6 months, you are saying?
Yes.
Okay, fine, sir.
Yeah.
And, okay, sir, fine. Thank you.
Thank you. The next question is from the line of Ujjwal Shah from Quest Investment Advisors. Please go ahead.
Yeah, thank you for the opportunity and congrats on good set of numbers, sir. Sir, was just looking through the presentation and found that on the stamping side, we now have Ashok Leyland as a customer as well. And we also have started a fully automated press line. Considering that we were previously catering mainly only to M&M, what kind of an opportunity does Ashok Leyland bring on table and the impact that could have on the margins?
No, first to clarify, we were not only supplying to M&M. M&M, as I said, M&M today is roughly in the range of 35 to 40% of our India revenues. And even earlier, it wasn't as if it was 100%. It was at its max, it was in the range of 50 to 55%.
Even for stamping business, Vikas?
No, for stampings business, it is much higher. That is correct.
Right.
So if your question is related to the stampings business, then it is correct observation that M&M is a very large participant in our stampings business. That's right. Yeah. So, and that is one of the reasons why we are looking at other customers.
True. So my question was, how big can be Ashok Leyland in this regards? And
no, so don't ask me for a number, please. But, again, as Hemant said, we would not put it up if it was not substantial enough, right? Only place where we are actually saying it is not substantial is EV's business. So we have said very clearly it is in very small numbers at the start, at the outset itself. I have mentioned that the EV's business is a pretty small supplies. But for Ashok Leyland and TDK that we have mentioned, and for the Ford numbers, F-150, those are all substantial numbers.
I think the positive way of looking at Ashok Leyland is that even though Mahindra is in the truck business, Tata is in the truck business, okay, and the Marutis and the others compete with Mahindra in the SUV business, okay, all these companies have got enough confidence in the governance standards of Mahindra CIE to be able to say that never mind if you supply a competitor, and never mind if a competitor owns 17% of the stock, okay, we trust you to deliver on what we want. Their intellectual property remains confidential, their numbers remain confidential. I do not want to discuss their forecasts of Ashok Leyland because I don't think I should be sharing commercially sensitive information about M&M to Ashok Leyland or vice versa.
No, and basically, a lot of this movement has happened because of the new norms on the cabin that has come up. Earlier, as you're aware, a lot of the sheet metal part, the commercial vehicles had very little sheet metal part of the business because, most of the bodybuilding was done outside and was not done by the OEMs. But now, as you're aware, there are new norms for new safety norms around the driver cabin and so on. And therefore, there is a need on the part of OEMs to source some of these material, and that is how we are benefiting out of Ashok Leyland.
Okay, thanks. Secondly, on the castings business, in the Q4 slide 5, we have mentioned that main profitability improvement has happened in castings. So what exactly has led to this?
Castings improvement. Ander, would you like to take that?
In Ander, we have mentioned specifically on slide number 5 that our profitability in castings has improved. So the question is, what are we doing in castings?
We were discussing this yesterday with Manoj, so maybe you can talk about how efficiency.
Yes, I am now in the castings plant. Okay, so we are making the operational review with all the team here in Urse plant. Okay,
right.
It's clear that during the last, I would say the last month, we have done a great job here in the casting plant. Okay, we have made some organizational changes. I mean, some positions and key positions we have changed, and we have been working to eliminate the bottlenecks in the production. During all the last, I would say the last couple of years, we have been struggling to fulfill with the delivery demands from our customers. We were short with the deliveries, especially because we have a couple of internal problems that we were not able to solve. During last 2-3 months, we have improved. We have, let's say, solved these bottlenecks, especially in the fettling area that we had a big problem. We changed some flow of the parts. We made a big project with the support from our Spanish engineering central team, so we will improve also our scrap rate, reducing the problem in the most critical parts. So just for give you an example, we were producing 3,500 tons per month every month. That was our average output on the plant. Right now we are producing more than 4,000 tons per month. Okay. Since November, we started producing more than 4,000 tons per month. So we solved our delivery issues with the customers. We improved our internal efficiency. Now the plant is working really, really hard. Okay, so I would say that it has been a management issue that we have already solved internally, and the results are improving. So it's helping us a lot to the growth, even because we can now sell more than we sold before, and of course in the profitability.
Ujjwal, on slide 18, if you look at, we have put one of the synergy case studies is actually pertaining to the castings business, to the foundry plant. Right. Of course, that is more on the quality and efficiency improvement plan. There you can see that we have talked about a savings of rupees 1 million per month and how it has come about. There are some photographs also on how it has been enabled, how material saving has happened, and so on and so forth. So you can have a look at that. So that is an illustration of what kind of work we are doing in the foundry business.
Sure, I would say that this is a big example, and a very clear example of the technology transfer from CIE to Mahindra CIE to India. Okay, we have had a team working 1 week per month here in India, coming from Spain to support the local team, to give the trainings, to prepare all the engineering tools to be used here in India. And this huge job that was done in the last 6-7 months now is giving it the fruits, and we can see now the improvements on the P&L and also on the customer satisfaction. Okay, just for your information also, this team is today is also here with us. I mean, I didn't know that when I arrived here in the morning. They are here working this week also to continue improving, especially the yield, the rejection rates, where we are now focused on. So let's say that this is a good example of technology transfer, and finally we are getting the expected results.
Great, Ander. And the last question to Ander. In terms of the EU business, what are our margin targets for CY18, and where do you think margin expansion can come from, especially for the MFE business? If not the numbers, if you can tell me in terms of what are the areas that you are targeting to get the desired margin expansion, especially for the MFE Germany business.
Yeah. Okay. In the European business, we expect the continue growing in terms of sales. I mean, turnover should increase. In terms of margin, we see that our Italian gears plant, as we are now growing importantly and we expect to have important growth, we will expect also to improve slightly the margins. Our forgings are doing perfectly. I think they are, let's say, Spanish forgings are doing properly. And in Lithuania plant, we will increase slightly also the margins because we will continue growing and as the new crankshaft line is already working. Okay, so those improvements will be there, especially because of the sales growth. Okay,
right.
This is a volume improvement due to this effect. And finally, regarding Germany, in Germany, you know that we were struggling a couple of years ago, and during the 2017 we stabilized the business, and quarter by quarter we have been showing a better result. Okay, so we, as you can see, the overall EBITDA margin you can see in the calendar year 17 report, but it has not been flat during the same all the year. So we started from lower figures and we are going up in a ramp. Okay, so we continue, or we expect to continue growing these margins. Probably the growth will not be as strong as it is because we started going from a very low margin, so that is easier to continue growing, but we are still far from our standards. Okay, so let's say that we expect growth in volumes, Italy and Lithuania, and we expect also improvement in Germany. I cannot give you the figures because, okay, I cannot disclose this information, but I can say you that we are strongly committed to continue improving these margins. And as I told you, during the 2017, quarter by quarter, we were improving slightly, but consolidating a better margins.
Right, sir. Just to probe a bit more, so in terms of Germany margins, do you think that now from here on it would be difficult to get margin expansion? Or which are the areas in particular that you are seeing there can be margin expansion for the German business?
Okay, I think that we have still some room for expansion. Okay, it was once we have reached a level or the minimum level that we fixed, we still have some room for improvement, and we expect to improve a little bit more. Yes, it will not be huge improvement because the technology and the market prices are not allowing to have an excellent margins on those components, but at least I would say that we have still some percentage to be improved. Yes.
Can I add something here? This is Hemant Luthra.
Sure.
One of the reasons why we try and encourage you to look at the company as a whole, because Ander as the CEO is responsible for the global forging plus everything else. But I'm just saying that when he's responsible for global forging, he can take decisions and is evaluating them. That if Bilforge has got a shortage of capacity, can that be serviced by doing something in Chakan? If in India the volumes are growing, can that be serviced by moving physically a press which may be underutilized in Europe? So I can't go through every little piece of what we are doing, but the focus on improving margins does not necessarily only come from the obvious stuff of tweaking something here or there. Something for those of you who understand Hindi, apologies for those who don't. कभी कभी बोलते हैं ना 100 सोनार की और 1 लोहार की. And that translates that a goldsmith uses 100 little taps of the hammer, and the guy who works with iron and metal can do the same thing by using one big crack at the hammer and therefore being more effective. So there are small steps you can take, also big steps you can take. So keep watching this space, because you all have, I believe, would have been pleasantly surprised with what's happened in Europe. And I hope we will continue to surprise you, not by only tinkering, but by taking some bold steps with respect to how the business is managed most optimally.
Great, sir. Thank you. Thank you for the answer.
Yep. Thank you. The next question is from the line of Venkat Subramaniam from Organic Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. The question is to Mr. Ander. MCIE actually has benefited enormously from the CIE association. But I just wanted to understand your thoughts on our capital structure. Given our capital structure, Mr. Ander, our Indian acquisitions are not going to be as accretive to shareholders as they can be, let's say, in the hands of other Indian companies. This is because you are foreign owned, etc. And there are domestic restrictions with respect to borrowing. Are you exploring non-equity options as and when an acquisition happens, sir?
I'm happy to, Andrew, go ahead, and then I'm happy to help you if you need it.
Yeah, okay. You know that we have this limitation to go to the, let's say, financial markets to buy companies due to the Indian law, okay? Yes. So we have to fund it through equity, okay? And our idea is still, let's say, that we, unless the law is changed, and okay, we, perhaps Hemant can make some comments on that. We have no chance than going to this capital increase, whatever, or funding through equity. However, what I would like to say is that we are always thinking on the shareholders when we do this, okay? And we want to create value. We will only do the operations or capital increase if we are creating value to our shareholders, okay? So this is very, very clear. We don't want to, and that's what we expect that they realize, and with the growth that Bilforge is giving us, and with the, let's say, the wider customer base that we have with Bilforge, with the Mexican business already starting to sell and to open a new market for us. Let's say that all of this is creating value. So we expect that any purchase that we do in the market in the next years or in the next months, quarters, whatever, we will create value for all of us. Okay. The point, and we, as you know, that we want, and we have the clear idea to continue growing our business. We want to be one of the key players in the Indian market. We want to develop our business both organically and inorganically. So let's say that we will continue creating the value that we have done till now. Okay, and of course we will show this. We will prepare, and we are now also it's important that we are preparing our strategic plan for the next 5-6 years. So all of this will be considered in our strategic plan.
Mr. Andrew, the limited point one was making, sir.
Let me jump in and supplement this before you ask a follow-up question and see if this helps you.
Sure.
You referred to some regulations, okay, which say that there are some restrictions on foreign-owned companies. Okay. We wouldn't have got to where we've got with CIE showing 4.5x price increase in 3 or 4 years since we've had this joint venture, and Mahindra CIE showing a 3 to 4x price increase since we had this joint venture, if there had not been some out-of-the-box thinking. My suspicion in my interaction with government officials at the senior-most level has led me to believe that this regulation that came was during the time when India was concerned about foreign-owned companies piling up debt, and that debt affecting Indian track record if that debt was not paid. And therefore they said that foreign-owned Indian companies should have some restriction on borrowing. But that restriction on borrowing creates some absurd situations. If we are looking at a company in India, and if we look at an equivalent company in Asia, because our mandate is not just India, but it is Asia, and if both the companies are the same size, and if both the companies have got a kind of a customer base that suits us, okay, under present Indian law, you can buy the foreign company and get debt from India. And therefore, when I have made presentations to the government of India, I have found a very sympathetic ear which says that by having this regulation, you're not serving the cause of Make in India. Because if it is easier for Mahindra CIE to buy a company abroad with identical numbers, then I'm not doing Make in India, but I might end up doing Make in Korea, Make in Vietnam, Make in Thailand, all of where such opportunities are available. At the same time, the banks keep running to us and saying that company A, B, C or D is under NCLT and under IBC processes, and would you like to consider it? Some of these companies could be of interest to us. Thirdly, the government's own philosophy may have been determined at a time when the rupee had slid to 69, and they wanted to make sure that whenever companies were bought, more foreign exchange were brought into the country. But at this time, you have the opposite situation, where the rupee has gone from 69 to 63, okay, and there is a surfeit of dollars, never mind the hiccups that have happened recently. So, is it possible, and I believe it is, that a government so focused on creating jobs might have a sympathetic ear to tweaking the regulations to serve the larger cause of creating jobs in India and Make in India? And I am reasonably optimistic that not only can the regulation be tweaked legitimately, I think they are sympathetic ear. And also, if you look at our track record, where the net financial debt to EBITDA is maybe 1.1, the debt to equity is whatever, okay. I think we are more conscious than anybody else that the return on equity must be protected so that you as shareholders feel comfortable. I cannot give you any specific dates about when I believe some of these things can happen, but trust Ander and trust us to make sure that the return on equity that you're looking for, okay, happens with some out-of-the-box thinking.
Sure. Mr. Luthra, see, the limited point here, sir, is that government, since it's actually running an agenda where, there are, as they deem it, more important issues, this may take a while. So pending that, I just wanted to find out whether Mr. Ander, as CEO of CIE, would be open to supporting from their balance sheet through a debt in case a domestic opportunity presents itself. So that's really what I wanted to hear from Mr. Ander.
Principle, yes. I mean, we can support anything that is good for the company. I mean, we are, let's say, analyzing the situation and the opportunities that we have in each region, and CIE, of course, is here to support anything that is good for the company and is supporting the growth of the company. So I would say that we are not close to that. I mean, but we are analyzing all the opportunities, and we will decide accordingly. I mean,
wonderful, sir. Nice to hear. Sir, I just had a follow-up question. As you would have noticed, there are a number of questions with respect to German operations. Our German operations in terms of financial parameters have continuously lagged the CIE parameters. Margins are lower, etc. And they also have tended to actually, the blended margins and the blended parameters also taken effect, because this is not a small operation. It's close to 200 million euros. Being a financially managed company and a very prudent company, would you hesitate to actually monetize this in case of higher growth opportunity persists? You don't have to commit, but I just wanted to understand what your thoughts are. Is it a holy cow in the Indian context?
Okay, let's say that our idea, as we are, let's say, or at least my experience in the past and also my mindset is fully operational. My idea is to solve and to make these German operations profitable for the company, okay? And that's where we are now. You know that we like we want to continue growing, and let's say that we are not considering any selling of these businesses in the short term, okay? You need to also realize that some of the customers, the main customers in Germany, are also global CIE customers like Daimler or MAN or Scania or Volvo, and of course we need to protect these customers, okay? So in principle, I think that our main task now is to continue with the turnaround of the business. Now I think that 2017, we gave a tremendous step in the right direction. So, our idea now is in 2018 we should improve a little bit more, give another step up to be closer and closer to the CIE standard. So, globally speaking, I would say that our focus right now is not selling it. I mean, that will be the easy way of making the business. No, we want to continue there, and we want to solve the companies.
Sure, sir. So aspirationally, to get close to the CIE parameters, would you say 2 years, 3 years, sir? How long do you think you can probably take?
Yes, I would say that probably the CIE parameters are really tough. I mean, they are benchmark in our automotive market. We will probably not be at that figures but what we would like is to be, let's say, close. I mean, perhaps 20-30% below CIE targets. That would be the target to be there.
That would be about 2 years, sir?
Excuse me?
That may take about 2 years, you would say, Mr. Ender?
Yes. In couple of years, yes.
Wonderful, sir. Thanks a lot, sir. Thanks for the opportunity.
Thank you. The next question.
One second. I just want to add to my response to Venkat. Because Ander has addressed the issue of addressing the needs of the customer and putting the customer first, if there is a method by which we can do that, okay, again, some out-of-the-box thinking. You've seen it being done in the case of JECO, okay, where one plant was shut and it took some effort to fix it, but it has been fixed, and therefore the overall numbers of Germany have gone up. But I don't think it'd be fair to either the customers, the employees, or anybody else to discuss on a public call, okay, what restructuring can be done other than to convey to you the confidence, okay, that whatever is done will be done in the interest of the customer and the shareholder and the employee. I don't want to get into a discussion as to what will be the restructuring, when will be the restructuring, how the restructuring happen, because this is a public forum and I don't want to jump any gun on that.
Totally appreciate, Mr. Luthra. Totally appreciate. Thanks a lot.
Yeah, Vinit.
Mahesh Pendre from Karvi Stockbroking, please go ahead with your questions.
Hi, sir. Thank you for the opportunity, sir. What are the capital expenditure plan for next 2 years?
CapEx for next CapEx. JP?
See, we've done about 300 crores this year, and I think since we are really now operating in many of the plants at full capacity, I would expect it to be around these numbers.
For next 2 years?
Yeah.
Sure. Thank you, sir.
Thank you. The next question is from the line of Bharat from Quest Investments. Please go ahead.
Hi, congratulations Mr. Andar and Vikas on good set of number and performance. Andar, I mean, we have this time outperformed Indian operation in terms of EBIT margin. EBIT margin is almost 50 basis points higher than the Indian operation. So, and we wanted to reach, I mean, this CIE EBIT margin level by 2026. In this whole journey, where exactly we are at this stage? Hello?
He doesn't have the number. Why don't you give the response?
Sorry, Andrew, if I can respond to that question. Your question is, so your question is when
the Indian EBIT margin around 8.7 and Europe margin is 9.2.
Yeah.
Resulting 9% for the whole company.
Yeah.
So we have some kind of, I mean, EBIT margin by 2020. So in that journey, where we are and how do we see every year, I mean, next couple of years?
So we have said that our goal is to get to 10% on EBIT.
Okay.
And you can see Europe is already pretty close. And India also, if you were to remove that one-time impact that we have in this quarter, of course, annualized it will have a little impact. We are in India also looking at reaching this 10% in the next couple of years. We are on that. I mean, we have some capacity, we have some room to improve, and we'll get there.
So there is so much room now left, I mean, to reach this 2020 level. But do you think we can cross, I mean, that because some of the capex also we have done, like Mexico, we are also further expanding the capacity on Belport. So is there room to cross that 10%? Hello? Hello?
Sir, we request you to stay connected. It seems that the management line has dropped. Please stay connected. Ladies and gentlemen, the line for the management seems to have disconnected. Please hold while we reconnect. We have the line for the management reconnected. Bharat, you may want to repeat your question.
Hello?
Yeah, Bharat. Sorry you got disconnected in between. I think you were talking about capex.
No, I mean, see, we have already reached 9% and next 3 years we are looking for 10%. But do you think that, I mean, the kind of pace that we have taken, I mean, improvement and now further we are improving capex on the putting in Mexico, in Belport, as well as in Lithuania, which is a high margin business. So can we cross that 10% margin by this 2020 EBIT margin?
This is for Europe, or you are saying at console level?
Console level.
Console level. Okay. No, I would think surely, because if we are getting top line growth, making some capital expenditure will definitely leverage our existing cost structure, and we should be able to do better.
Okay, that's a great. Thank you very much. That's all from my side.
Thanks, Bharat.
Thank you. The next question is from the line of Priya Ranjan from Systematic Shares and Stock. Please go ahead.
Thanks for taking my question. My question is on the key financial metrics or the key covenants, what you said. So, in terms of 2-3 parameters, still we are way behind, particularly the RONA and FCF to EBITDA, which is, I think, the FCF to EBITDA target is somewhere around 50% and RONA is around 20%. So, do you see that it's achievable in next 2-3 years, or what is the midterm target in that sense?
Okay, to answer your question, yes, the RONA is at 12%, and you would know that's because of the only recent acquisition of Billforge. So we expect Billforge to do the growth that was envisaged, and like you heard earlier, they are very much on a line. So as the growth kicks in from Billforge at that kind of high margins, the RONA should definitely improve. Having said that, we will have to also improve in Europe and some of our businesses in India, which is all on the radar, and that's how we are going to get to the RONA that we have sort of set out to achieve. FCF, I think it would be RONA which we would really pursue, and on FCF, yes, if capex is required, we'll have to make them, right.
So, but the capex will come with the growth as well. So
yes. So I think we'll go ahead with the capex if growth is coming in. So
what you're saying is that we'll prioritize RONA over FCF.
Yes.
And the other thing is that we moved from 9% to 11.9. I'm sorry we haven't moved from 9 to 20 in 1 year, but the heart is in the right place and the focus is in the right place. That's all that I can say. We hear you loud and clear.
Yeah, but my worry is, India, the assets doesn't come at cheap price. So even if we go ahead and do a couple of more acquisitions,
No.
So the RONA will be under pressure because it will come with a significant amount of goodwill.
I hear you loud and clear. I think you heard Ander also saying that we are hearing this feedback from our shareholders, recording it and absorbing it. It's not as if it's only external, it is internal, because we benchmark against ourselves, and we know that shareholders have a choice to go elsewhere wherever they get a better return. So you heard Anders say that we are going to look at stuff, whatever we do is going to be earnings accretive. You've also heard him say that there are people are spending a week, a month over here to make sure that the improvement that you see in gears and stampings and others is, and what you see in foundry is accelerated. So you will have to trust us to not to ignore your feedback about RONA and ROE.
And sir, on capacity utilization, and what capacity utilization will be in Europe, each geography separately, if you can share it.
Ander, you want, I don't know how you can define it, because there may be some pieces of Europe that are running flat out, some that are not. But for example, in the case of Metal Castello, I know a conscious decision was taken that you would weed out the unprofitable products so that you would create headroom and get the EBITDA margins up, which they've succeeded in doing quite brilliantly. So let me turn it back to Ander, and so because there's forging, there's ring, there's gears, and everything cannot be.
I would say that the capacity utilization is, of course, is different in each of the units that we have. Okay, but speaking overall in let's say our capacity right now in Europe can be something like at 90%. That is the European capacity. In Germany, we have slightly less than that. We can be at 70% of capacity. This is average. And in India, okay, it's also depending on the businesses. We have some businesses where we are at full rate, like full capacity, for example, in Bill Forge, or we are at full capacity also in the gears business. And in the other businesses, we can have an 80, 75, 80% of utilization. So that's more or less our situation.
Okay. And in terms of the new orders, you have said the orders which I think the execution is already happened. So can you share some, the new orders or any which are yet to be executed, maybe in next 1 year or 2 years you plan to execute?
Okay, yes, one of the key commercial important facts or indicator that we follow are the new order incoming. Let's say that in 2017 in India and in Europe we fulfilled our internal targets. That means that we have been successful in the market. Right now, even in the beginning of 2018, we have had some important, and we were making the follow-up during these days. We have been successful to get new businesses with other customers. Some of them are for sport. So let's say that the order book is really strong. In the last month was important, and we fulfilled our internal targets. And 2018 has started also with a very strong order book realization. Okay, so globally speaking, I think that we are in a good path. What we are perceived by the customers as a reliable supplier, and that's where we are working right now. So I cannot disclose the contract that we have been awarded, but the trend is positive and the expectations are also very good.
Okay, thank you. That's all.
Thank you. The next question is from the line of Jinesh Gandhi from Motilal Oswal Securities. Please go ahead.
Hi, sir. You mentioned that in European business there was this write back of provisioning for stocks. What would be the quantum for that write back?
Okay. What we did is during the complete year, just in order to avoid any problem at the end of the year during the audit period, we provisioned some of the stocks as, let's say, that the control over these stocks in our German companies in the beginning of, let's say, after the crisis we had was not really reliable. Okay, so we set up the internal SAP system properly, but just in case we created some provisions in order to protect ourselves by the end of the year, because you know that our companies, especially in Germany, we have more than 1,000 live part numbers in each of the plants. Okay, that means that the control is quite complex. Right now, everything is perfectly controlled in the system. The SAP system was set up and completely clean, and we corrected these provisions that we made. That we made these provisions on excess. Okay, so that was the reason of this correction in the stocks.
Sure. My question was, what would be the quantum for that write back?
It was something like 60 million rupees, more or less.
60 million rupees.
Something less than 1 million euros.
Okay. And secondly, you talked about Mexico plant. We have added one new customer, and that would in turn require to add new capacity. So can you throw light on, is this equally as big as an order as we have got for the original Mexico plant, or this would be just a supplementary order? And what would be the capex which you would have to do for Mexico plant?
Yeah, the order is supplementary. The main order that we got from GKN was much bigger than this, but but it's supplementary, but it's relevant. Okay, we are talking about more than 5 million euros. Okay, so this is an important order. And regarding the investment, we have already done during the 2017. Part of the investment was one press that we have already installed, and okay, we are now commissioning this press. So we still have to fulfill the complete investment line, but the most important part of this investment is already done.
Okay, and euro 5 million is the cumulative order or annual size?
Annual sales. Annual sales, yeah.
Okay, and lastly, on Mexico plant, you indicated current output is 30% of utilization.
Yeah.
Okay, and by year end, we should be close to about 50-60%?
Yeah, we are in a ramp with the customer. Right now, we are already at, I would say, 40% more or less. We expect to be, 70-80% by the end of the year, yes.
Okay. Okay, great, sir. Thanks and all the best.
Thank you. Thank you very much.
A reminder to the participants, anyone who wishes to ask a question may press star and 1. As there are no further questions, I now hand the conference over to the management for their closing comments.
Gentlemen, thank you very much. We note that you like the results, and we note your concerns about the future and how return on capital employed and return on equity needs to be protected to satisfy you. And the management will continue to push for operating results, and as the team leaders, we will continue to push in the direction of the concerns that you have voiced on the call today. Should any of you have any follow-on questions, I think most of you know Vikas, and if there are other questions, I'm saying Vikas can be used as a funnel to address any unanswered inputs. Thanks very much, everybody, and good day and good afternoon.
Thank you.